My name is Jaramis, Financial Advisor at Treysta Wealth Management. Thank you for taking the time to watch a short video we've put together on an important topic, business succession planning. As a business owner, we understand that on a day-to-day basis, your focus would primarily be on the operations and efficiencies and profitability of the business, not necessarily focusing on a long-term exit strategy. At Treysta, we encourage our clients to understand what their exit strategy is, both on a voluntary basis and an involuntary basis. I've asked Ed Bastingthwaite, industry expert, to come in and have a chat to me and share his insights on this issue.
Business succession planning is essentially planning for the future, how you're actually going to exit the business. Some people want to build up a business to sell it as a retirement plan, some want to pass it on to their family. But a business succession plan is not just selling the business, passing it on to the next generation. They really need to think about that's a voluntary transaction. That's I'm exiting this business of my own accord. They also need to think about an involuntary succession where there may be a death or a disability or a severe illness like cancer, and they need to think about how their exit will be based on that situation. Business succession planning is a very important subject to me. It's the reason that I'm working here in the city. I'm actually a farmer's son from New South Wales, and the reason I am working here in the city is purely because my family many years ago didn't have a formal succession plan in place, and the business wasn't left in a way that it would have been in a better shape passing it on to the next generation. So I've lived a poor succession plan, and it's my motivation for everyone else to be better prepared. So succession planning is important. So with the voluntary succession, you actually have choice because you've actually got time on your side. When you actually want to succeed from a business, you can go to a bank and borrow money or whatever the new partners or new owners need to do. You have time, there's a handover period that you can transition out of the business. But in an involuntary instance, there's no time. Time is the biggest enemy in an involuntary succession. You need things to happen quickly, and you need to be able to make choices quickly, and money actually gives you those choices. It gives you the financial freedom to actually do what everyone wants to do, not what you're forced to do. So we actually had a death in our family, and that meant that assets and the business were actually transferred over to other family members. But when that transaction occurred, the assets and everything were passed across and handed over. It wasn't formalised and structured in an agreement as to what everyone would like to do. So there was a lot of grey area there, a lot of fighting in that situation. But besides the asset transaction, a lot of debt was actually transferred as well because of that death. So in an ideal situation, what would have been better to happen would have been for the debts to be paid off and left, so the remaining people had these assets and business left debt-free. But there might have been a situation where the people that were left to didn't actually want any involvement in the business, so they could have been formally handed a cheque for their value of their shares, and then they could have gone off and done whatever they would like. I'd strongly encourage any business owner to sit down with all the partners and stakeholders involved, the spouses, the other family members, to sit down as a group with a facilitator like a financial advisor or an accountant, and formally identify, okay, how are we going to value the business? If we were to succeed out, how would we like that to occur from a voluntary situation, and what kind of plan can we put in place? But then on an involuntary need, okay, what would we like to happen? So if partner A died, partner A's spouse might not want anything to do with that business. So that's an opportunity for all business partners to agree that she needs to be bought out, and then what funding mechanism are we going to put in place to make that transaction occur? Should we borrow money? Should we use insurance? Should we sell some assets? Should we bring in a new partner? You need to have these conversations up front, so there is no bickering, there is no bitterness, and everyone can move on with their lives. I think any time's the right time. Even starting out, you need to know what your future goal is. When you're actually starting out in business, you're not starting with nothing in mind, you're going to have a business plan in place. Why not have a succession plan backing up that business plan? I think insurance is, in my view, the best solution in an involuntary succession need, because you need choices and you need to make decisions quickly. And if you have debts in the business, banks, if you read a loan agreement, will often have a clause in there which says, due to a death or disability, we have the right to call in the loan at any time. If you have that kind of clause in there and you don't actually have any insurance in place, you can be forced to sell assets, which could be very disruptive to the business, sell your family home, anything's on the line. So I believe insurance is great because it's a very quick transaction. It makes things happen quickly and smoothly. Succession planning is not insurance. Succession planning is about how do I pass this asset from me to the next person. That's what succession planning is. It's not necessarily insurance. Insurance is a vehicle that could be used to help a share transaction occur in a business, but there are many different options available, like borrowing cash or bringing in new partners, whatever it might be. So it is an option, but it's not necessarily the option. When you think about it, if I had the option of either borrowing money or actually going and getting an insurance policy, if I borrowed $1 million, I'd have to pay back at least $1 million of the capital I borrow, plus interest over 2, 3, 5, 10 years. So I could be paying essentially 120, 130% of the capital that I borrow. If I had insurance, $1 million insurance contract on myself, that might be a few $1,000s a year.
Thank you very much for watching our video. These are our contact details, and if you have any questions or would like to understand how a business succession plan may help you and your business, please don't hesitate to get in touch.